Futures trading involves substantial risk of loss and may not be suitable for all investors.
Good afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the Chicago Board of Trade. Today is Monday, December 1st. I hope you all had a great Thanksgiving, a lot of good time with family and friends and good food, whether that be the traditional turkey or if you upgraded to something a little bit better like some prime rib or some beef tenderloin. Nonetheless, here we are back in the saddle, the first trading day of the last trading day of the month, and it was a choppy one in the ag markets. We'll jump kind of straight into things. We've got March corn futures pulled up here. March finished down 2 3/4 to 445. Early in this morning's regular trading hours, it looked like we were going to make another move to the upside following Friday's friendly price action. We took out Friday's highs just by a couple ticks, got out above the 200-day moving average just by a couple of ticks, but really fizzled out there. 449 was the high of the session, and then we retreated off of that. So the rejection against those resistance levels, Friday's high and the 200-day moving average, a little bit of a caution flag here in the near term, but not a lot of technical damage outside of that. We managed to test and hold the 20-day moving average, which is this purple line here, and Friday's low. So that's going to be key here through the middle part of the week, 443.5 to 444 3/4. That's going to be the line in the sand for the bulls to defend. A failure there, you could potentially start to see some retracements and further snowball selling to retrace Wednesday's big move higher that could potentially take us back towards a 50-day moving average, and trend line support comes in about 439 to 440. Weekly export inspections this morning, very friendly, above the top end of expectations. So demand continues to be strong for the corn market, which I think ultimately probably helps us mark higher lows and higher highs over time. Last week, we touched on a seasonal spread, too, between March and December 2026 futures. That is posted on our Blue Line Futures portal. So if you've not seen the historical charts, head over to Blue Line Futures and you can get that information there. And if you don't have access to that, well, you know how to do it. There's the sign up button on the website. Submit your information and we'll get you logged in to take a look at that. Now, moving over to the soybean market. Again, we got out above resistance in the overnight trade. It looked like the market was going to kind of reaccelerate to the upside following a friendly trade in the back half of last week, but we fizzled out. 1135, 1137 is the pocket that we've been kind of talking about, the top end of that meat grinder box, and we noted last week a failure there, and you're starting to see what looks like a bearish head and shoulders pattern, and as you can see, with today's rejection, that tends to be kind of what we're staring at in the face here. Now, there again, like corn, not a lot of technical damage, but certainly concerning that we rejected those higher levels. We're back below the 20-day moving average just by a hair, which we've been tethered to for the better part of the last week and a half. If we cannot find our footing here in the next couple of sessions, a potential retest to support 1112, 1116 could be in the cards. And then that, I think, ultimately is the inflection point here in the near term. A break and close below there, and you could start to see the selling accelerate. And the next psychological and technical level would be that $11 handle. And below that, you're looking at the breakout point, the mid 1080s. So those are some key levels to keep a close eye on. As far as weekly export inspections go, they're about in line with expectations. So kind of ho-hum there. But again, a lot to be made if we're going to break out or break down from this box. It looked like we were going to break out to the upside. Today's price action puts us right back into it and certainly raises a caution flag here as far as the technical basis goes. Now, jumping over to the wheat market, we've got March Chicago wheat futures pulled up here, down 3.5 on the day, 535, just largely sideways, right on that 50-day moving average over the last week, which you can see here. Weekly export inspections, so-so. Nothing to write home about. I believe it was just below or at the low end of expectations. So not great, but if you look at where we are year over year, we're still ahead of where we were. So some positive and some negative, which keeps us largely sideways here in price. I wish I had more conviction one way or the other here. I would like to be optimistic on the wheat market, but the technicals are kind of keeping me at bay for the time being. Now, if we were to get back out above the 20 and 100-day moving averages here, 440 or 545, 548, potentially that would reignite some optimism, and you could potentially make the case that, hey, buy on momentum, buy on strength. That's the play. But right now, sideways trend here over the last week. Don't see a whole lot to get excited about. Now, moving over to the livestock side of things, we've got February live cattle futures pulled up here. We got to the 20-day moving average at the end of last week. basically right where we opened and tagged a high this morning, and then we settled back in. All in all, I wouldn't be surprised to see this market settle into a range. However, there are some big silver linings, and we talked about this in last Monday's video and throughout last week's daily write-ups. The volume that we saw traded in live cattle last Monday, very constructive. The options market, when we were lock limit lower, very constructive. Not a lot of panic, and there was heavy volume on that lock limit lower day, which indicated to me that somebody's willing to pick up the scraps when other people were trying to throw them in. That was ultimately encouraging. And then we got the podcast with Secretary Rollins on Tuesday, which seemed to alleviate some concerns about that southern border opening sooner rather than later. She did note that it is a matter of if, not when, but seemed to indicate it's probably a little bit further down the pipeline. All right, so where does that leave us on the chart? Well, we get out above this 20-day moving average near 219, potentially make a run near 225, but I think that's going to kind of be the upward barrier of this market unless we get cash to really just kick back up and get into gear. On the downside, 210 is a support pocket, so you're going to be looking at 210 to 215 as a potential range. Now that a lot of that excess or that fund length that we've seen in the market over the last several months kind of sucked out of the market, I think we can get back to a more normal trading environment and cattle, where I think there will be opportunities on both sides of the market. It's not just, oh, we're going back to record highs or we're going to zero. I think we're going to probably consolidate, see volatility come back in, and establish a little bit more of a trading range. And hopping over to the feeder cattle market, I think largely we're kind of looking for the same thing, albeit it's a big meat grinder box. We talked about the meat grinder box in the soybean market. For feeder cattle, we're talking about a big range from about, I don't know, call it 315 to 335. That's a massive pocket. That's about the equivalent of a $2 meat grinder box for soybeans as far as a monetary basis goes. So tread lightly in the feeders. Manage your risk. These swings are big. They're not for the faint of heart. So if you don't have to have a position, I would probably recommend just being a spectator in this market for the near term. Now, over on the lean hog side of things, to wrap things off, had a nice strong open on Friday, couldn't retain that strength. And then today had a nice strong open, couldn't retain that strength. So rejecting higher prices on the last two opens is a little bit of a caution flag, but we're still trying to carve out a low against these late November lows, which I think is encouraging. On top of that, we're starting to hear some concerns of African swine fever picking up in Spain, which is a top 3 pork producer in the world and a top 2 exporter in the world. If that continues to grow and those fears start to grow, I wouldn't be surprised to see lean hogs pick up a little bit of steam and some fear premium get into those markets, especially in those deferred contracts. So that's going to be something to keep a close eye on. If you want to talk to us about how to play that, whether it be with futures or options or combinations, don't hesitate to reach out. We are always here to help. And I guess that kind of wraps things off. Kind of a choppy trade day here to start the first week, or the first day and the first week of the month. If you have any questions, we are here. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.